My name is Andrea Tinianow, and welcome to the Blockchain Issue Safari. I'm a Delaware attorney, and I'm Chief Legal Officer for ILV Labs. I'd like to include my co-presenters today. Drew, why don't you start, and Danny, and then Jason.
Thanks so much, Andrea. Good morning, everyone, especially to our friends who are in person in Wyoming. We know that it's 8 a.m., and so we'd like to commend you for coming in bright and early for a huge dose of legal excitement. My name is Drew Hinkes. I'm a partner at K&L Gates in the Miami office. I'm also an adjunct professor at the NYU Stern School of Business and Stern School of Law. I speak both academically and to trade audiences and legal audiences about crypto asset, blockchain, smart contract, DeFi related issues. Really excited to be on the panel here. Let me pass it now off to Jason.
Hi, thanks so much, Drew, and thanks, Andrea. Great to be here with you all. My name is Jason Gottlieb. I am a partner at Morrison Cohen in New York, where I chair our white collar and regulatory enforcement practice group, which basically means I defend people from the government. And lately that is mostly in the crypto and blockchain and DeFi space. So we're gonna talk about a whole bunch of interesting issues today. And I'm looking forward to talking about some enforcement and regulatory perspectives on things.
Danny, can you tell them a little about yourself?
Okay. Hey, everybody. It's very nice to see you this morning. My name is Danny Alter. I'm a partner at Yankwitt LLP. I used to be the government. In a prior incarnation, I was the general counsel for the New York State Department of Financial Services. And, I think based upon what we're going to talk about today, I'm going to be Mr. Left Field in terms of raising issues that hopefully folks haven't thought too much about, but should be on the lookout for.
So thank you so much. I don't have any insight into who is here and who is on the Zoom call. Is there a way for us to know if people can communicate with us? I have absolutely no idea. Is anyone here on the panel or in the production know if we have folks on the line with us? Okay, because since this isn't interactive, will people be able to speak up and ask us questions as we're going? Oh, so we're the only ones on Zoom. Okay. And the room. So the folks, are there folks in that room right now? Do we know? Okay, we don't know. Okay. All right. So it looks like it's us. Looks like we're going to have a great conversation. So for everyone watching, we have 3 hypotheticals today, each one of them dealing with issues pertaining to blockchain and decentralized finance. And so we'll just get started. I'll read the first one, and I would ask, we'll just get started here. So we have a group of coders. They get together, they create a DeFi protocol, and this is based on the ERC20 Ethereum protocol, and they call it Uniswap. So the DeFi protocol enables the users to provide liquidity, to provide crypto into a liquidity pool, and they get a governance token in exchange. And this protocol takes off. Now there are thousands of users, and they're using this protocol to exchange their crypto. But what happens? A core group of coders receive a revenue stream for every transaction, and the coders integrate their app on several blockchains. They arrange for joint marketing with the blockchain promoters. So this is normally where I'd ask our audience for questions, but we don't have one. So I'm going to start out by asking the panelists, what issues do you see here?
So I'll jump right in. This is Drew. The first thing to think about is whether this Uniswap organization or association of coders is really decentralized or DeFi at all. We don't have a canonical understanding of what the word decentralized means or what DeFi means. These are sort of trade usage terms, but they generally coalesce around the idea that there are not legally addressable or easily identifiable persons that are in control of the system. So one of the things that we need to think about first is, in this hypothetical tuna swap, who is in control of the system? And to answer the question of who's in control, we have to think about what sort of means of control or what control is relevant or material. Here you would think about who can change the code to this sort of pooling system that's been created, who benefits from the operation of the code that they've created, and who is able to make decisions about the pool that's been created. Here we've got a group of coders that have created this thing. It doesn't appear that they have necessarily turned over development keys or socialized the ability to update or change the code to any third parties.
So, but Drew, let me stop you for a second. Let's assume, so they've created the code and now it's open source, right? So they're saying it's open source. The code is for anyone to use. How does that
using
change?
Code versus controlling the ability to spot flaws in it and update the code, to fix the code if there are emergent zero-day types of hacks, or decision-making as to what sort of features or functionalities should be added or changed about the code. And finally, manipulating the ability as to who can benefit from the operation of the code, meaning the stream of revenue that comes from each transaction going to the coders here. Those are the sorts of control that are probably relevant to regulators, and that would be relevant to a judge if they were trying to figure out, who do you sue when something goes wrong with tuna swap?
So to our former regulator on the panel, Danny, what's your take? Just, we're going to add some additional facts here, but given the scant facts we have, what jumps out at you as a former regulator?
Well, the first thing when I read this scenario, I thought, perhaps it'd be interesting to come at it not so much from the code and the protocol, but rather from the asset perspective. So,
okay.
And there have been some recent developments that people might not associate with these kind of concerns, but actually I think one should think about it. Very recently, for example, big news, El Salvador made Bitcoin a national currency. That changes the nature of the asset significantly. It used to be that cryptocurrencies, digital assets, the big question was, is it a security? Is it a utility token? Now you have it as a national currency. And with that comes a whole host of potential regulatory questions that no one's really ever thought about before. For example, does the lending function, essentially, of this protocol make tuna swap some kind of bank under federal or state law? If it's not a bank, is it, for example, in New York anyway, it's known as an investment company, which is empowered to take deposits and pay people interest or returns on those deposits. This is not a function so much of the control that's exercised by the coder or by the protocol, which is all critical to determining whether it's a security and falls under that rule of regulation, but it goes to the very nature of the transaction that's at issue. And states are especially concerned and have expressed concern for consumer protections, for protections on usury, depending upon how much interest is being earned or how much is being charged, essentially, whether to ensure that the deposited assets are safe and protected and in some way insured. So
wait, I'm sorry, please. I was just going to jump to Jason for a second, but please continue.
No, go to Jason. That's fine.
No, this is really interesting. So I think that's really interesting. So from Drew, we have the take on how much control. Is it truly decentralized? Do this group of coders that got together to create the code, are they still actively controlling, or have they somehow been able to relinquish their control over the code, and it's out there without their little paw prints on the code? But Jason, I'd love to get your take on what you see here, because it's chock full. Danny was looking at the assets and even considering if Bitcoin were one of the assets, now you may bring in a whole swath of regulations that hadn't been contemplated before. Jason, what's your take?
Well, I think I want to take what Drew is saying as the starting off point. If you're looking to see, what can go wrong, if something goes wrong,
what happens and who's going to, right.
Exactly.
And so we have the additional fact here. So why don't you take that?
Well, okay, so we have this additional fact. A bug siphons off crypto to a third party. The coders fix the bug and replace the missing crypto. So this has a whole bunch of questions that are raised here. So how did that happen? Who's responsible for the bug? Where did that crypto come from? Did it come from, was it newly created crypto? Was it crypto that belonged to other users of the network who had staked their coins? If so, who can they look to try to fix that? It's when it says the coders fix the bug and replace the missing crypto, I guess that's good for the people who had their crypto taken. But does the person who actually does that third party have any legal claims? In fact, there is a case pending in California that I'm involved with that involves some of these very facts. You also have to.
Just for pure disclaimer, we did not discuss the facts before. I had no idea when this was written that you were involved in the case.
No, that's absolutely no problem. And the only thing that I'll comment about that case is my client is exactly 100% in the right.
Of course.
But the question of the coders fixing the bug, does that raise questions of their centralization or control? And does it matter how they do that, right? There's a big difference between coders fixing the bug if they have the admin keys and can push the changes to the network. That suggests that maybe they're not decentralized at all. They're what Hester Peirce has called a DINO, decentralized in name only. But if they wrote a patch and then had a community governance vote to implement that patch, and the community voted to do so, well, then that suggests maybe they are decentralized for better or worse. That takes time, that takes effort, and maybe in the meantime, the person who took the funds went and ran them through Tornado Cash or siphoned them off in other ways, and that time lag that's necessitated by decentralization can create problems. So there are balances that these groups of coders have to strike in decentralization or not, and they have to choose which path they want and why they would choose to be decentralized at all. They have to think about that.
Sure. No, that's just great. So I guess I think this is the final additional fact is, the SEC is, as we know, and all the regulatory arms are looking at DeFi and these protocols, and they're concerned because there no longer is an intermediary, in the middle, the trusted intermediary lending out money or other, well, money, not other assets really. And they somehow are able to identify who those original coders are somehow, maybe through investigatory work or they're well known, and they send them, they want to have a conversation. They send a request. And so what do you think, where do you think this, what do you think? I'll go back to Drew. How does this end up? Do the coders have, do they have the protections they need to thwart the advances of the SEC
So this is my single favorite question, and I'm grateful that you offered me this softball, Andrea, because I'm going to try to crank it over the fence right now. DeFi describes the way that participants organize themselves in order to act as to property or legal rights. Okay. It does not
say that again. Wait, say that again. That was really good, Drew. Say it really slowly. I like
DeFi refers to the way in which people organize themselves to affect rights to legal property or other legal rights. It does not necessarily imply or mandate a specific legal entity be used or not used. You can have DeFi as an approach to governing a legal entity, or you could just have a whole bunch of people in a weird, willy-nilly, sort of chaotic way come up with their own rules as to how to make decisions. We have seen, we see DeFi at its core expressed in general elections where every person gets to cast a vote. We see different approaches to governance in different corporate forms. We see them in non-corporate forms. Trade unions, religious organizations historically didn't always incorporate, but some jurisdictions decided to give them the same legal rights that you see in incorporated entities, like Georgia, for instance, which acknowledges non-incorporated groups of people. So when you say DeFi, we have to figure out, are we talking about the way that people organize to make decisions, or are we talking about
So
what I'm talking about. Going to your question specifically, Andrea, now that we said DeFi is an organized, not a legal entity. In this tuna swap hypo, we have a group of people that have acted together to try to accomplish a goal, and that is to publish some software. This hypothetical doesn't say whether they have an incorporated entity or not. Let's assume that they don't.
Let's assume that they don't.
Each participant could hypothetically be assumed or implied by a court to be a general partner or a joint venture to each other. For those of you who have never had the pleasure of going in front of a judge or litigating, you will find that where legal rules do not expressly apply to certain conduct or questions, courts will look at common law or at statutes to try to figure out, what does this kind of look like? They'll squint and they'll try to figure out, what does this sort of look like? And a group of people acting together without a liability shield through incorporated form will probably look like a general partnership or a joint venture. What does that mean to those coders? It means that those coders may be jointly and severally liable for all of the liability of the collective.
But it looks like you're assuming that the SEC is going to bring some kind of enforcement action against them, and then they'll all be joint and severally liable. Is that what you're telling us?
Well, I think your question was, how could they find these coders and who can they hold responsible? And I think the answer is, it's a race it's sort of like outrunning a bear. You don't have to outrun the bear. You just have to outrun your slowest friend. If you are in a group of 20 coders who are anons, you just have to be the 19th best at being a non. And, maybe the one who's the worst is the one that is caught.
The one they catch. That's great. I love it. I love the analogy. And okay, I think
I would just add though.
Please.
That you can run, but you can't hide, because the SEC in that context, their investigatory powers are broader perhaps than their enforcement powers. So I don't see an obstacle here if they find out who the coders are, for the coders to become subject to a subpoena, so that the SEC can find out the specifics of just what Drew was talking about. What's the nature of the relationship going on? On the one hand, you might have a great First Amendment argument if you're just a coder, right? If you're just putting up code and you're expressing it, there should not be an implied partnership, because I never engaged with an intent to enter a joint venture. I wanted to share my thoughts on how something might be done. But if there is more than that, if the investigation shows that there was an actual agreement or an implicit agreement, or there were some actions that were actually taken to implement the code, you could be in a very different world. So there's a practical side to it, and then there's the legal argument side to it, both of which have a lot of knots.
Thanks so much, Danny. There was one other point that I wanted to raise, and just the notion of that these coders are receiving a stream for every transaction, and even if they're truly decentralized, these streams could be going to an unhosted wallet. What is that? I'm just, I'd love to get maybe Jason, if you could give us your thoughts on that, what that represents and what you think the SEC might do with that.
Yeah, so a couple of thoughts, and one just follow up on what Dan and Drew have said about this notion of an unincorporated partnership, or it could pull everyone together. I agree with Drew that is likely what the law is, or what a judge would construe the law to be. And I also think that that's a very stupid way of looking at these things. Not Drew's take, which is 100% right, but the law is, the
law is stupid.
The law is an ass, an idiot, right? He's looking at it that way, because that doesn't assign any relative weight to what the coders do. You could have 5 coders who created this, 3 of whom were deeply, intimately involved. One who pitched in some code on some parts, and one guy who, you know, fixed a couple bugs and then went along his way. But you also have all the people who are using the DeFi protocol, right? If I staked, you know, a half of Bitcoin on one protocol for 5 minutes and then said, nah, this isn't for me, and walked away, have I become part of that protocol? Have I become one of the partners that the SEC could go after for participating in that protocol or being a member of the protocol in some way? Could I possibly have unlimited liability for anything that happens in the 5 minutes that I was there? That doesn't seem to make sense. And I think as the law shakes out, you know, judges aren't going to go for this sort of expansive notion of unlimited liability for any general partner associated with it, but are going to look more facts and circumstances and say, okay, well, if you were the coder who put this out there, then maybe, you know, you can be held more responsible. But, you know, even the coder who didn't really have much to do with it might be excused, much less our hypothetical, you know, reduction.
So you have the practicalities. You really have the practicalities of the impact of the law against the law itself, which just, you know, makes everybody part of the partnership. So I think that's really interesting, sort of those conflicting forces rubbing up against each other.
So now to answer the question that you actually asked.
That's fine. I like the other one.
A lot of these protocols have money going to smart contracts that sit in the protocol, and the money can be used for various things. It can be used for further development. Many of the protocols have developed grants programs where people can get together and vote to use that money in certain ways for the betterment of the protocol, etc. The question of whose money that is quite an interesting one, and the regulators certainly ask questions about that. As Drew suggested, where's the money going is part of the analysis of whether we think this is truly decentralized. Because if that money is going to the group of coders and it goes into their pockets and is being run for their profit, it looks much less decentralized. But if it's sitting in a smart contract used sort of for the good of the protocol, subject to protocol votes, maybe that's more decentralized. And as these protocols grow, it'll be interesting to see what they choose to do with their treasuries. There are all sorts of very advanced ways to think about treasury management and how those pools of money can be used, particularly for example, for reimbursing folks who lose money through hacks, as in our first hypothetical. So if you have that kind of excess insurance money, and then to go back to the questions that Dan was asking, does this look like a bank? Does this look like some sort of regulated entity? And if you've got enough money sitting in the smart contracts that can be used for things like that, you may actually have a higher reserve ratio than is required for banks. So it seems sort of silly, in my view, for regulators to come after these protocols and say, you're not following all the rules. Oh my gosh, if something goes wrong, all these, moms and pops could be screwed. And that's why we've got all these banking regulatory rules anyway. But if you actually have a bigger reserve for those problems than the banks do, then you're solving for the problem that the regulations are trying to address, which is why I think respectfully to all the regulators out there, they want to think more about the reasons for the regulations and whether those problems are being solved.
But Jason, just to respectfully push back a bit. You're discussing there are a lot of protocols out there. Some are well funded, some may not be. So that assumes that there's going to be a robust treasury, well-funded treasury, but you may not have some. That may not be the case, or there may be issues. We just saw, I think we've seen in the news, there have been some failings in some DeFi protocols due to actually the blockchain layer having a problem. So, even though, listen, there could be issues, with every situation, but you're discussing sort of the the perfect case. But
well, I think it has to, I think what we need is a different framework.
A different framework yes, I think you're absolutely right.
Nobody, you walk into any bank branch in America, and they've got security cameras and a panic button and
right, because we know what those issues are that we're up against.
So here, I think part of what regulators are struggling with is trying to figure out what are the problems, how do they map onto the current regime, and what technological solutions can there be, and are those technological solutions enough to solve the problems, and how does that square with the current regulations that we have?
Okay, listen, this is great. I think we keep on going, but we have two more hypotheticals, everyone. So let's move to the second hypo. And this one turns to something I think that Drew was hinting at, this notion of a decentralized organization. So I'll read the hypo and then we'll dig in. PigBook is a widely successful social media platform. Its owners want to leverage its user base to raise money to save the environment. The PigBook company, I should just say the PigBook creates a DAO and sells governance tokens. The revenue generated will become part of the DAO's treasury. Token holders will have an opportunity to make proposals for how the money can be used. The first proposal seeks $50,000 to purchase land in the Amazon to protect it from deforestation. Another proposal seeks to invest in a tech startup that uses clean energy to mine Bitcoin and entitles token holders to a slice of the profit. The third proposal seeks to, we've got three proposals. A third proposal seeks to invest in clean tech projects with no opportunity for a return. So we've got a social media platform, and we've got a group that comes together. They call themselves a DAO. So that's one thing we have to take apart. I'm gonna leave it up to the one of you to please just tell us briefly what the DAO is and what a DAO is. And I know I actually have heard Drew define it. So maybe Drew, you can jump in since you're our professor on the panel, and then we'll dig into the issues. And it'll be about sort of how the DAO works and how the money is used and what issues that creates.
Thanks, Andrea. So the hypothetical starts, at least as written, with a company creating a DAO. And so the first question is, what's a DAO? The term is decentralized autonomous organization, but you can pretty much take all three of those words and throw them out the window, because nobody understands exactly precisely what decentralized means. None of these are autonomous, and most of them go to great pains to try to not be organizations, at least from a legal standpoint. So really what we're thinking about in most contexts is a non-entity that has people participating using certain technology tools to engage in governance over some property. And I came out with an incredibly clumsy term called a nutmeg, non-entity with technically management governance. Don't use it. No one will know what you're talking about. Stick with DAO. That's the term the industry uses. But think about it as though we have people that are using technology tools to engage in collective governance over some property. In this case, we have a DAO that sells digital assets, right? You have a group of people selling governance tokens. I don't know what a governance token is, so let's just get rid of the word governance and let's just say we've got a group of people who are selling tokens. So if all of your securities bells aren't ringing right now, you probably haven't been paying attention for the last 5 years. Let's put that aside for the moment. The revenue that they raise is going to become part of the DAO's treasury. First thing I think about is who's got their finger on the switch here? Who's managing this treasury? What rules are imposed on that person or legal entity that has control over value on behalf of this unincorporated group of people?
But you said that legal entity, so I'm going to stop you here, because if we're creating a DAO, basically it's usually unincorporated, unassociated.
Right.
So if you're creating a DAO and you're having a group that is being governed by a code that's being put in place and rules, and then this code, there's a treasury associated with it. So there are, as you said, what are the rules? But we don't know necessarily that it's one person, right? There
right. So the hypo doesn't say that the treasury is a wallet that's under control of one person, or it's a smart contract. If it's a smart contract, then hypothetically, we can argue that there isn't a discrete identifiable person in control of it. It might be subject to the rules of the code.
Exactly.
We can go down a whole rabbit trail of what that means and whether saying it's delegated to the code actually just is a sleight of hand or whether it's meaningful or not. But let's get to the point of what this thing is intending to do. It's collecting value from a whole bunch of people, and it's using it to do a couple of things. It's using it to buy land to protect it from deforestation. Cool. It's using it to try to make money. Securities bells should be ringing. Or it's using it to invest in clean tech with no opportunity for a return. So let's kind of, we have some things that look more like securities, some things that look less like securities as far as the types of investments in which this organization of people is intended to enter into. The issue I want to sort of tee up is, what rights or powers do the holders of the governance tokens actually have? And how does anybody know? We don't know to whom they were sold or how they were sold, but we have to think about where these powers and rights come from. And I want to make one distinction, and then I'll hand this back to Andrea for moderation.
Okay, sure.
Powers and rights are legal words. They come from recognition under the law. Abilities are technical words that come from the context of the system. What you can do with a token is an ability. A power and a right comes from the law.
Right. So as we're putting these, putting the rules together, I guess the pig book company, the social media platform, would create the rules for the DAO. I wonder, Jason or Danny, if you have any thoughts about that in particular.
I'll jump in here because I want to talk about the meta nature of this grants program within the larger governance token. So as you said, if the company creates a DAO and sells governance tokens and sells tokens, and you know, again, their securities bells may be ringing. But then we've got another level here. If the money that's collected sits, whether it sits in a smart contract that's subject to a community vote, whether it's allocated to a grants council that has a multi-sig control over that smart contract, however it's done, if people are making an investment into a grants council for the purpose of making some profit or an expectation of profit, then the work of the grants council itself arguably could be considered a security. So you've got the initial security, and then you've got a sort of mini security sitting on top of it. It's almost like a nested problem. It's like a Hilbert security or something like that, a meta security. But we see differences in how they are used, and you can get out of that problem the ways that you would normally get out of being a security in the first place. So if you have a proposal seeking $50,000 to purchase land in the Amazon to protect it from deforestation, it doesn't seem like there is any expectation of profit there.
Exactly.
So you're failing the Howey test. If you're investing in a tech startup to get a slice of the profit, then maybe that itself would be expectation of profit. But you have to ask yourself, where is this money coming from in the first place?
But the other thing is, but the other thing, Jason, is these are proposals. So potentially the council that is reviewing it would have the ability to say, you know, if we do this, we're going to get into regulatory issues.
No, that's exactly right. I mean, if the proposal, these are all sort of good, clean, facially legal proposals, right? Whether or not they're securities that would require for registration is a separate thing. But nobody here is submitting a proposal for a governance vote that they should take $50,000 from the smart contract and hand it to a North Korean citizen for the purpose of selling drugs to
terrorism.
Yeah, exactly. So obviously, if you have something like that, and the multi-sig says that sounds good to us, this is not legal advice, but yeah, don't do that, right? So you need to think about what these purposes are. Obviously, illegal purposes are problems. You may have KYC kinds of problems, right? If a non-developer, 228 comes out and says, I want to take $50,000 to do this cool thing on the network, well, okay, that's fine. But really, someone should know who that anonymous developer is.
So that it sounds like what you're saying is it sounds like. Jason, I'm just going to say, it sounds like what you're saying is, as these rules for the governance of the DAO is being developed, then they need to bake in KYC and other issues pertaining to what is and what is not legal, what can and cannot be done for legal purpose.
So it depends. It depends on what it is, who's doing what, right, and who can know, right? the degree of KYC that you have to do, and this really isn't sort of a KYC issue because it's not really knowing your customer,
Right.
but it's just sort of a generalized,
OFAC
right?
type
You want to
of,
make sure that you're not dealing with people who are on a sanctions list.
Exactly.
So, there are traps that you should probably run. At least somebody should know that if the person who's making the proposal is some, high professor, at Rutgers, then okay, fine, who cares? But if it's someone on the sanctions list, that's a problem.
So Jason, it sounds like you're raising the type of issues that you would raise with really any legitimate business. These are the things that as a business you do. And I actually want to throw this to Danny because I know Danny had some thoughts about this as well in terms of it's looking and sounding like a nonprofit and the types of issues that raises and other related issues. So could you take that, please?
Yeah, this has all been incredibly interesting, and I think it's extremely important. I just say, hold the phone a second. When we first started talking about blockchain, we were talking about disruptive technologies, right? Well, you just disrupted in this little conversation. I don't know how many bedrock areas of Anglo-American law that have been in place for centuries. For example,
exactly.
And you got to deal with it, because if you don't, you'll end up in trouble, and your great idea is going to get squashed.
But Danny, this is a decentralized organization,
well,
right?
Something. Wait, hold the phone, because this does sound very much like a non-for-profit charitable organization. And guess what? There are 50 attorneys general around the United States that take that function very seriously. And primarily because there's a whole big old opportunity for fraud.
And Danny, can I just raise one question? And the fact that this DAO actually was created by a corporation, I suspect that also, right?
Yes,
the Pigbook
because
company.
You're going to begin at the beginning. Right.
Exactly.
There are people, you're going to have to make regulators comfortable with the notion that either the governance program really is fraud type, whether or not the decentralization could lead you off into, an engagement with North Korea. These are all kinds of things that are very practical and maybe small-minded, but they exist, and you have to deal with it. For example, I don't know any non-entity that can own property. Can you tell me who?
Yes, a trade association, a labor union.
No, that's an entity. No, my friend.
Not in every jurisdiction.
It doesn't have to be incorporated. I said.
So really, what you're saying is what legal and only legal entities can be recognized as having legal powers like ownership.
That's exactly my point.
Mm-hmm.
So,
I like this.
That's exactly my point. So, who's going to hold title to the rainforest?
That was exactly my question. If a DAO says, I'm going to go buy 5,000 shares of stock, somebody actually has to be given actual authority to act on behalf of the DAO and has to be able to sort of create the decentralized interface to the legally addressable legal entity world. And this is the tension point that underscores so much of what we do in crypto. How do you bridge between rules that are created by code and legal obligations that are fixed by extrinsic law, especially if you think about the complexity of the overlay between 214 different legal systems as might affect one technology system?
Add to that the fact that at its best, the law is usually 10 years behind innovation in terms with establishing rules that at least make some sense and maximize efficiency. So, you got the same problem for the Bitcoin mining operation. You got the same problem for the, who will own the investments in the clean tech properties. That's the stock you were just referring to, Drew.
So we can add a fact, which is, and actually just sort of some of the state jurisdictions have tried to address this by creating entities that DAOs could wrap themselves in, right? So create legal entities and register with the state in Wyoming, for example.
Well, that may be, but who's going to be liable, right? I mean, I don't know if those structures provide for paying a judgment. And let's not leave out the one organization that may have the biggest grip of all, the IRS. You are dealing with a nonprofit organization, right? Are your donations tax deductible? Does the organization owe taxes to the government if it's not found to be, a non-for-profit? I mean, there are many different schemes at work here, which, they were.
It sounds like the makings of a really good law article, truthfully.
Yeah, or a really troubling lawsuit.
Troubling lawsuit.
Because until and unless, as I think folks were saying, as Jason was saying, that judges look around to fit square pegs in round holes, and it's often very unsatisfying. And if you're the square peg, you usually get your corners shaved off. And you've got to be very careful. There's a dialogue that needs to take place. This may sound mundane at this point, but with each of these new efforts, I don't think it's the most effective course of conduct to, act first and ask for forgiveness later, because there may be too much to forgive.
It's interesting.
In any one context.
I think that's a great closing, and actually spoken like a former regulator. But I love the points. Really just fabulous. We're going to move on to the third hypo, and it's shorter, but it's fresh off the success of its Pigbook DAO. The Pigbook creates a stablecoin, ONC which is equivalent to $1. It tends to promote to its users, the Pigbook users. And Pigbook is working with the New York State licensed trust company to hold a basket of assets, including ONC BTC, ETH, and others, to back the stablecoin. And so it's not going to ONC is not going to be in the basket. Sorry, that's a mistake. It seeks to get its token, his stablecoin, and its DAO token listed on exchanges. Will it have success, and what are the issues? So we have they created DAO. They've got a lot of activity, a lot of success, and now they're going to create a stablecoin. So who wants to start on this one? There's quite a lot there. I'll ask the question, is that ONC stablecoin a security?
So this is Drew. I'll start, and I'll preface this, and maybe we should have all done this at the beginning, that these are all our individual views, not the views of our law firms, universities, clients, or spouses. These are just what we think. There's a lot of controversy about what stablecoins are under U.S. law. Some of them might look like bank deposits. Some of them might look like demand notes. Some of them might look like loans. Some of them might look like securities. The one that's identified here, which is nominally where its value nominally is associated with the value of a basket of assets, some of which are viewed as commodities under U.S. law, may or may not be a security. The reality is that a lot of these stable coins kind of look, if you squint, like a bunch of other things that we know, but there is no existing legally defined asset that maps exactly onto a digital asset that is issued by a company that holds some other value against it. There are lots of things that look kind of like it, and depending on how you look at it, it could be a commodity, it could be a swap, it could be a mutual fund, it could be a demand note, it could just be garden variety debt, or it could be something different. It could be a banking deposit, or maybe we need to ask Congress to look at this and think about the policy behind the regulation of all these different animals, all these different types of assets that I just mentioned, and think about whether the same policy considerations would make sense to apply to the assets that we are seeing out there in the world acting as stablecoins. And given that I've been so pedantic about nomenclature, I don't want to disappoint anybody. The word stablecoin is almost as meaningless as DAO. because nothing is stable compared to anything else. Everything has value measured against something else. The only things that are arguably stable are things that are that are broadly used as a unit of account, because we think about things in terms of dollars, and we assume that things are going to be priced in dollars. That doesn't mean that the value of a dollar doesn't fluctuate, because of course it does. So I will now kick it back to Andrea now that I've done my little pedantic thing.
Yeah, no, that's great. I mean, as you say, stablecoin is a term of art that's come about, and it generally is used to indicate that a digital asset or token has the equivalency of $1, but it doesn't have to be a dollar. It could be other form of currency, and generally those stable coins are backed by something, but we can't really know necessarily what it is backed by, and or who's holding the assets, or who's doing the accounting on those assets.
Well, let me jump in on
Sure, please.
Less of a legal point and more of a kind of economics point.
Yeah.
Going to Drew's point about stable compared to what. So if Pigbook creates a stable coin, so it sells an Oink USD and it takes $1, and it takes that dollar and puts it in a safe or a bank or something else. It doesn't touch the dollar. That is as stable as one can get, because it has $1 for every Oink USD that it's issued. And if anyone wants to redeem their Oink USD, then the company
can get their dollar back.
That's as stable as it gets. But then if you start working with a basket of assets like Bitcoin or ETH or other kinds of coins, you risk the fluctuation of those coins. And then what do? So let's say on day one, the value of Bitcoin doubles. Well, that's great, because what you've done, what Pigbook has done, is it's taken a Bitcoin and it's sold an Oink USD. We can go in fractions given what the Bitcoin price is, but let's just call it 1-for-1 for simplicity right now. They take a Bitcoin, they give an Oink USD, price of Bitcoin doubles. The next day, the person wants to redeem their Oink USD. Only half of the Bitcoin that now exists has to go back, and they've made a profit. Well, that sounds awesome. That's a great business model, as long as the Bitcoin, ETH, et cetera, are going up. But what happens if the price of Bitcoin halves that next day? Well, then Oink USD holder says, hey, I've got my one Oink USD. I want to give it back. Give me back my one Bitcoin. All of a sudden, Pigbook says, oh, wait a minute. We have a little bit of a problem here, right? We don't have enough cash to cover that. It's not actually stable. So what happens? Either Pigbook has to have a massive reserve able to withstand the fluctuation of those assets, or it has to pay people back in some manner, whether it's first come, first serve or pro rata. And that's where you can get economic risks that are going to fall onto Pigbook. So at the beginning, when Drew said, we got to look to see what goes wrong, that's a pretty big thing that can go wrong for Pigbook.
Right. And, and we know about in the early days of our country, there were runs on banks, or not even the early days. During the Depression, there were runs on banks because people were afraid that the banks didn't have the cash to support their passbook, and they wanted to get it back. And this is the same type of issue that can come up again. I'd like to turn to Danny, because this takes place, or the trust companies in New York State Trust Company. That's not that was done intentionally, and that raises all sorts of issues. I'd like you.
Yeah, I think
please.
Given our gracious host today, this might be a shout out for Wyoming, and I'll tell you why.
Please.
Well, you got to ask yourself, first of all, putting the trust companies aside for a moment, if you're going to do business in New York, and one would think that, I guess, don't put them aside for a moment, but just for the purpose of actually working with trust companies, does Pigbook need a BIT license? And then again, how does a DAO get a BIT license? The definition of BIT license includes the creation of a virtual currency. So if you were in the business of creating virtual currency, under the regs, you need a BIT license to do business in or with New Yorkers.
So perhaps we should be in Wyoming, and
Well, that's what I'm saying. So,
and they should be using their special purpose depository institution, their Speedy Bank, and the Speedy could hold whether it's Kraken or what probably or Avanti will hold those digital assets and perhaps provide other services in support of that stablecoin and without the red tape that New York offers. Is that what you're thinking of?
That's certainly one route. The other route would be, it's time for regulators. I just think this is a matter of history, which moves faster and faster as we progress. It's time for regulators to kind of do a reevaluation of the nature of assets that they're regulating. This goes to a point made before. In the beginning, the notion that there would be something like a DAO that itself generated virtual currencies was just simply not in the minds of people who were trying to get their arms around the concept of a virtual currency at all. So, if you were making one, people thought they were in their garage or in their basement, popping out tokens, and you could require that person to have a license, that entity to have a license. So maybe that definition doesn't apply as directly anymore, and it's worth reevaluating.
Considering
it also doesn't go, it really doesn't get away from the problem that we talked about before, which is, what is Pigbook, and how can it, grant rights and indulge liabilities? I'm not, that's still a question that regulators.
The Pigbook DAO. I mean, the
Right.
Pigbook DAO.
Right.
Yeah.
Yeah. So yes, there may be more friendly jurisdictions, whether it's a specialty bank in Wyoming, some other banks and other trust companies that come up around the country that would be more friendly, but I don't think it answers the fundamental issues that are at play, which, really just as a market and as a global governance concern need to be resolved, need to be addressed, even on an interim basis. Everybody is so frightened of promulgating interim rules, right? That's like, they're there, but no one really ever uses them. Which
are you talking about the federal agencies, or are you talking about
state agencies? Interim rules are usually just that, something to keep the people within the guardrails while you're figuring out a better way. And it's been everything so far in my experience in watching the development of these markets, everything has been an all or nothing kind of gamble with government. And, I don't think that is the most responsible way of approaching things. You can take baby steps without which, protect against some concerns and at the same time allows things like DAOs to develop and not having already encased them in rules that from the outset, create a problem. So that's a meta issue, but
I think that's really interesting. I haven't heard people propose that. I think, we've heard about sandboxes, we've heard about 3-year plans, but these interim rules, that could be a nice solution.
If you're acting within the rules at the time, that's a safe harbor for you. You're following the law, but that isn't to say, and you understand as a business reality, that the rules may change. Now that may be an obstacle to investment, but there are economic ways around that.
So thanks, Danny. We have just a few minutes left. And I want to thank the Wyoming Hackathon and everyone there. We wish we could be there with you. I want to thank so much my co-presenters today, Danny, Jason, and Drew. Just phenomenal comments. Really got me thinking. Do each of you have just a few words on this ever-changing, nascent, not so nascent ecosystem that we're all a part of?
I'll start. We are obviously innovating at dramatically fast speeds. Our regulators, as Danny pointed out, are going to be behind. They are going to react. what it suggests for us is that as a community of people who are interested in these technologies and these assets, that we have a choice. We can act surprised when regulators who have not been informed by the industry and by the space regulate in ways that we don't think make sense. Or we can be proactive. We can reach out to lawmakers, policy makers, regulators, and communicate with them about what's going on, educate them, and establish a way for the industry to have an open and meaningful dialogue. I think it's something that has been missing in our industry and something that we all collectively should prioritize. There's trillions of dollars sloshing around in these assets and in this industry. It's time for us to start acting like that kind of industry and advocate on our own behalf. Thanks, everybody.
Thanks, Drew. Jason, any parting comments or words? We have like 2 minutes, so you have like 30 seconds.
Very brief. To follow on that, I think we need to emphasize that we're here to strike a balance. We want to follow certain rules. We want to protect moms and pops. We want to protect against fraud. We want to make sure people have disclosures. We understand the reasons for the rules, but we have to address the places where those rules don't make sense, where it is a square peg round hole problem, so we're not getting those corners shaved off, as Danny so wisely put it. That's what we have to do. We got to get to that balance. And then the very last point, I can't believe we've gone an hour without making a single joke about how what Pig Book was doing was not kosher.
Amazing. Okay, Danny, any final
Well, it's
thoughts?
hard to follow on that observation, but I would just join the link here and saying that one way perhaps the industry might think about going and starting that dialogue with regulators and government would be through entities, think tanks that are really independent, right? A lot of the think tanks who do wonderful work are viewed as a factual matter as advocates and to some extent lobbyists. And that's the nature of the beast. It's the nature of government. You know, if there were really independent think tanks out there, perhaps sponsored generally, I don't know, I don't have the answer to that, but that drew upon both economists and lawyers working together to figure out
and technologists.
Right, following the technology, of course. You know, to make a presentation that wasn't necessarily in one favor of one side or another, and to really crystallize the hard questions for legislators to think about. I think there would be a credibility.
That would mean kumbaya moment for our legislators, which is, you know what, let's be aspirational here. You guys are great. Thank you to Wyoming. We're out of here. Bye, everybody.
Thanks, everyone.
Bye-bye.
Thanks, everybody.
Pleasure.
Bye-bye.